Hello, friends. If you've been worried, if you've been taken aback, and if you've been surprised about what's happening in silver ETFs and on the whole in the price of gold and silver, this video should help you clear out your mind and get a clearer idea of where things are going, both in terms of gold and silver, more specifically for silver, of course. Hi, I'm Vijay Bhambwani. I've been trading these markets since 1986, and through my videos, I try to help newbie traders basically step up their learning curve and get to where they want to be as successful traders in shortest possible times. A word of caution here, a lot of imposters are on social media, have opened Facebook, Twitter, and other social media accounts with my pictures, soliciting memberships and paid advisory services. These are all fakes and they are scams. I do not offer any paid services. All my videos, all my social media accounts are free to air. Now, let's dive right into the video and let's specifically start with what's happening in silver ETFs. Now, the surprising aspect that took many a trader by surprise was that ETFs, especially silver ETFs, which used to trade at a discount to MCX silver and spot silver, not only started trading at a premium, but one that is Kotak actually went out there and stopped fresh buying in their silver ETF. First of all, on my Telegram channel, which is one social media account where I put out the maximum amount of my database research, statistical files, and other downloaded data packs that you can get for free from this account, I wrote out a post 2 days ago, which kind of led to a lot of messages saying, Vijay, are you suddenly turning bearish or cautious on silver? Hey, if you go through my videos on other channels that I have appeared on my TV shows and in my newspaper articles, you will see that from years I have been bullish on both gold and silver. A little more biased towards silver, please. The reasons for being bullish I have explained to you in this video still remain in place. And in this video, I have also told you why I favor physical gold and silver as compared to electronic formats. Please do go through this video. You will see how you can test the gold for purity, buy at honest to God prices, and negotiate buyback prices and contracts so you pay the least amount in bid and offer spreads. So, what basically happened in silver ETFs? Why did they start going from discount to cash to premium to cash? And particularly, why do silver ETFs trade at a discount? Now, you see, if you see the mutual fund charter, just like a limited company, a private limited or a public limited company has a memorandum and article of association, you will see that the mutual fund has a mutual fund charter. You will see that these gold and silver ETFs do not, I repeat, do not invest 100% of the assets under management into physical gold or silver. Some could be deploying 90%, some could be deploying 95%. Why is it that they don't deploy 100%? Part of the reason, of course, is, they are keeping cash so that if prices decline suddenly, they could average down and buy on the cheap. True. But the other opinion is also that they also are allowed to hedge in the commodity futures and options market just in case prices were to turn adverse. And not all hedge trades turn out to be profitable. You and I know that. So just in case the hedge trade is loss making, it deflates the net asset value of that ETF. And the market puts the ETF at a discount, saying we know that some amount of losses might occur. If not, then the NAV might be marked up, which is why your ETFs trade at a discount to spot and the MCX futures price in any case. Now what happened, why the ETFs went into kind of positive contango was that traders, wholesalers who are importing silver from overseas and then selling it to jewelry stores, to semi-wholesalers and retailers, suddenly saw that physical arrivals of silver were getting delayed. So you could book a 30 kilo lab of silver, or you could book what in Mumbai is called a chausa. Chausa is an uncut bar of silver, hand cut rather bar of silver, which is uneven. It cannot be 1000 grams just like an exact machine cut bar. And because it is hand cut, it is cheaper to make, and therefore it trades at a discount to the machine cut silver bar. So they basically are off late saying that whether you want a 30 kilogram slab of silver or you want a chausa, you have to put up money up front and then take delivery after 5, 6 or even 8 days, and the tenure could get longer, which means you could even actually have to wind up waiting for 15 days. Now, this has led to panic buying. The more people are being told that, hey, we don't have delivery of silver, the more they are trying to grab silver. Does this remind you of what happened in 2011? It should, because I remember I was on Facebook in those days. I didn't have a Twitter account in 2008. LinkedIn, I was not present either. And in those days, I was on contractual agreement with CNBC India. And I used to do a lot of shows on gold and silver, and I used to say that this frenzy where people are basically willing to pay a premium on silver bars is crazy, it's unusual, and these are signs of caution. Now, if you actually go and talk to a Zaveri Bazaar, which is the bullion market, which is present in every city, in this video where I taught you how to buy, I've also told you how to negotiate prices, etc. Do take a look at this video. If you go to Zaveri Bazaar, you will see that the bid and offer spread, which means the price differential between the buy and the sell price in a jewelry store or a goldsmith is, hold your breath, up to 20,000 rupees per kilogram of silver. So it's possible that when you want to buy, he will sell it to you at, say, hypothetically 1,65,000, but when you want to sell, he'll tell you, I'll buy from you at 1,45,000. Why is this bid and offer spread so wide? Which is normally no more than 1,000-1,200 rupees a kilo. Why? This is the market maker or the wholesaler's way of saying, look, I expect the price to go violently in either direction, either up or down. Now, if I have sold you my silver and the price goes up and I'm unable to buy more from the next guy, I would have lost out on my stock. So I'm charging you a bigger spread so that my loss is minimized. And why is he paying so less when you try to sell? He says, look, after I buy from you, maybe the price will come down. He doesn't know which way the price is going to go. All that the spread is saying is he expects the price to go violently in either direction. So he's saying, I might buy silver from you and then it could collapse. So I want to blunt the blow. I want to reduce my losses, and therefore I'm quoting such a wide premium. Now, this is why the fund house has stopped any more purchases in their silver ETFs. They have very clearly stated that we will allow open purchases just like before, only when prices of physical silver turn back to normalcy, and then you could basically go out there and start investing again. Now, is it possible that more fund houses come out and stop investors from buying their ETFs? Yes, it's possible. If this madness of shortage of physical silver continues, it is possible. Now, why am I saying that I prefer physical gold and silver? Part of it, of course, is in the video. The reason now I'm coming to ETF is, right now, the ETF is trading to an equivalent of 4 to 5, maybe even 6,000 rupees per kilo higher than the MCX price. Now, this is a huge cost of carry. Remember, I've been telling you to learn about a very important theory called the cost of fund theory. I've recommended 3 free online books of Dick Stoken, quite simply the gold standard on this subject. So basically what you're saying is that you're going to pay 5,000 to 7,000 rupees premium by buying ETFs, which you are normally supposed to trade at a discount. Now, there will be mean reversion. At some point in time, the physical shortage will correct itself. The old rule in commodity markets is that the cure for high commodity prices is high commodity prices. Why? Hey, commodities are found in the ground. So when there is a shortage of anything at all, you dig deeper into the ground, you pull out more from the earth, sell it, and that extra supply brings down the prices and the physical supply. Now, what happens when the mean reversion occurs in ETF prices? That 5 rupees or 6 rupees per gram, which is 5 to 7,000 rupees per kilogram premium, reverts back to a discount of 1 to 2 rupees, or which is 2,000 rupees per kilogram loss. You will wind up paying this 7,000 rupees per kilo loss as a bid and offer spread. The contango to backwardation spread. That is a direct loss. That does not happen in physical silver. You are all reading horror stories, or at least the rumors of horror stories of how the US government was worried when President Trump came to power, and Elon Musk also said this, that we are not sure whether there is enough gold in Fort Knox in the US Treasury as much as it appears in the books of accounts of the US Federal Reserve, which means we think we have this much, but the physical gold may not be that much. Now, this is why world over ETFs are now suddenly being looked at with suspicion, and people are going crazy in buying physical gold and silver, which is why physical availability is running short. What about the long-term view, and what about the short-term view? The long-term view, I assure you, in both gold and silver is up. In the short term, I am slightly worried because the waters have been muddied. I don't want to pay this 20,000 rupees spread to a wholesaler between the bid and the offer spread. It's criminal. It's criminal. It'll take me many months, if not many quarters, to recover this loss if I was to buy and sell in physical. Remember, there's GST also after that. All right. So whenever the prices mean revert on the ETFs, you could lose money just because the premium turns to a discount. So in the near term, there could be volatility. Over the long run, the reason why I told you is that the rampant printing of unbacked fiat currencies the world over is going to trigger the kind of inflation that your and my generation has never seen. Forget about my children and my grandchildren's generation. They've not seen that kind of inflation coming, and it's coming. The worst kind of inflation that mankind can experience is food price inflation. Why? Because food is not something that you can negotiate with. You can't say instead of 2 or 3 meals a day, I'm going to cut down to 1 meal a day and I'll be just fine. You will cut down the consumption of everything else and buy food first. And if you go to the FAO's website, the FAO means the Food and Agricultural Organization. It's a subsidiary of the United Nations Organization. You do please go there and check out for yourself what the food price inflation for the coming 5, 7, 10 years is like. You will then know why gold and silver will need to go up, because these are the primary hedges against inflation. So the long-term outlook is up. It's the short-term outlook where volatility is occurring. So what is the remedy for the short-term volatility? Now in this video, I taught you about how Mexico thought of or invented is a very strong word, but thought of is a better word. Petróleos Mexicano, which is Pemex, has a headquarter in a Hacienda, which is a villa. Now in Mexico, in the Hacienda, Petróleos Mexicanos came out with a strategy of a tail risk hedge which is called the Hacienda hedge. By this Hacienda hedge, which I've explained in this video, Pemex basically insured itself against steep falls, if any, in crude oil prices, which enabled it to continue to sell crude at lower and lower prices and still not lose money. So these tail risk hedges are something that you can deploy in your gold and silver holdings. If prices do not fall, and I don't want them to fall for my online family, what you will lose is a very small fraction of the hedging costs that will be written off. That's all right. That's a small cost to pay, because since the time I've recommended gold and silver, both have more than doubled. In the case of silver, it has more than tripled. All right. So a small fraction to pay on Hacienda hedges is not something that will kill you. But if at all, and I don't want you to sell any gold or silver, especially if you're holding physical stuff. This is not something that you will be able to buy back in a hurry at those elevated costs, because the bid and offer spreads will remain elevated, not at the present level, but will remain elevated. The jeweler will take advantage of you. So what you can do is basically ride the up move, which I think still has a lot of strong legs to go, but profit from down moves, if any, and earn some pocket change, which will also be substantial in the Hacienda hedge, as I've explained in that short video. What about the other theories that are fueling the price of gold and silver? There are a lot of gobbledygook theories that float around in the market, and one of the most amazing theories is the dollar milkshake theory. I do not believe in the dollar milkshake theory. That theory ironically says that it's possible for the government to continue to print US dollars as much as they want at free will, flood the market with dollars, and whenever it wants, when the money supply has become excessive, just like you sip a milkshake with a thick straw, you can suck out the dollars from the economy, from the banking system, from the financial markets and money markets, and not cause any problems. Hey, talk about liquidity problems. Dick Stoken's books will tell you that money, or at least cheap money, is mother's milk to a bull market. The minute you raise the cost of funds or you reduce the availability of funds, see how prices fall. So the dollar milkshake theory is based on a faulty premise. So is the MMT, the modern money market theory. From my point of view, of course, feel free to differ, feel free to disagree with me. Comment section is open below. Do let me know what you think. So as long as you have unbacked currency printing being flagrantly and persistently followed and implemented, I am pretty okay with holding on to gold and silver and advising you to hold on to gold and silver, provided you are not leveraging. By leveraging, I mean buying in futures and options, or even in the delivery segment via ETF or physical segment, and resorting to MTF, margin funded trading, where the cost of borrowing money to buy gold and silver can actually reach as high as 15, if not 17% per annum. Who are you working for? The financer or yourself? So do not leverage. Buy as little as your pocket can allow, but do not pay interest on it. I still think the best days for gold and silver are yet to come. Friends, before I sign off from this video, a reminder to subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alert about fresh videos being put about here. In the comment segment, do let me know how my videos help you become a better trader. And hey, please share my videos with family and friends so I can spread the cult of knowledge-based investments and trades. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable trade ahead. Take care. Bye-bye.